Big bargain chains have emerged top amid the persistent inflation. Now, some have recorded up to 15% increase in sales. But for smaller mom-and-pop shops, they are continuing to struggle.
Tucked below an HDB block in Yishun is this provision shop, which has been there for 36 years. Its owner, Mr. Ramasamy, says he's facing losses of up to 40% monthly due to rising costs and slowing business.
I cannot spend much. Last time I got car, now I don't have, I'm going by bus. So reduce my expenses. Electricity expensive, my rent also increased. All the goods I'm buying expensive, but no business.
But what has been a bane for Mr. Ramasamy has been a boon for bargain store chains like this Value Dollar store, which has some 94 stores island-wide. Sourcing from countries where variants of items could be priced cheaper has helped it to alleviate the impact of inflation.
We had to raise prices of certain of our items. However, due to our sourcing capabilities and our efficient back-end logistics, we are able to minimize the cost impact, cut off the middleman, and whatever savings we get in the whole process, we pass it on to our consumers.
It's a move that has attracted value hunters, with footfall up by about 20%. And helping the firm reach new consumer markets like young families and professionals. So it's looking to expand its product range to include more household essentials.
This rising trend is there for household necessary items, and we are also sourcing and visiting as much places to source for new products. Consumers tend to like newer variety as the time goes by, and we are committed to keep increasing it on a weekly, monthly, daily basis.
For Mr. Ramasamy's small provision shop, this high volume and scale is something he can't compete with. Still, for the 73-year-old, he's determined to keep his business running and serve the neighborhood for as long as he can.
For more analysis, I'm now joined by Dr. Aurobindo Ghosh, Assistant Professor of Finance Education at SMU. He's also Director of the SMU Financial Literacy, Inclusion and Technology Program. Professor Ghosh, September's core inflation is at 2%, and the central bank is targeting to reach 2% by year end. How feasible is this?
Well, thanks for having me. In fact, what we are seeing right now, that there is a downward trend in the longer run. And that downward trend, of course, it takes a little while for the monetary policy to take effect. So we see that indeed the headline inflation is at 2%. The core inflation is about 2.8%. It has gone up a little bit, but this is only monthly. So over a longer term, when you average, you see that there is a more of a downward trend in the core inflation as well.
And what would this mean for the cost of living concerns, especially for the different income groups here in Singapore?
So as we can see that, well, core inflation or headline inflation is basically made up of a basket of goods and services that individuals buy. But it turns out that for lower income households, the essential expenditure on essential items like food, for example, or housing might form a higher portion, which means that if there's a higher price impact or higher inflation for those necessary commodities, then obviously the pinch that is felt by the lower income group is higher. So while in some sense we see a gradual decline, but the impact, like for example, for food inflation, which has come down quite substantially as well, might be higher. Accommodation hasn't gone down as much as expected, even though the private road transportation has actually gone down. But that might have certain impact there, but still it's definitely harder times for lower income group with the general cost of living pressures.
Are you anticipating saving rates being impacted as well if income doesn't keep pace with inflation?
So obviously, when you look at a higher portion of your income going into daily necessities, so that the amount that you could save, in the standard 50-30-20, where 50% on essential items, 30% on discretionary, and 20% of savings, if indeed you have to spend more than the 50% of your income on essentials, then the part that will be impacted is both discretionary as well as the savings. So indeed, there might be a cost pressure if prices don't come down sooner for the comfort of particularly the lower income group, the bottom 20%, then that would be a challenge for the saving that they can potentially make.
And MES opting to keep its monetary policy stance unchanged last week, even as other economies slashed interest rates. What's your take on this? It comes amid escalations in geopolitical conflicts.
That's exactly right. So given that we are importing most of the commodities that we are using from countries which are dollar denominated, and US dollar being the currency of the international market. So if indeed the dollar comes down to some extent, that will of course help ease pressures on like oil imports and cost of energy, for example. So that's something that we are keeping an eye on. So what MAS has done is sort of maintain the current stance till there is enough signals that the prices actually come down closer to the 2% target that is essentially our inflation target in the Western economies, including US and European Union. So indeed, MAS maintaining the stance is because we don't actually see that strong enough decline in the inflation, particularly both the inflation that people are facing and imported inflation. The exchange rate driven monetary policy really tackles the imported inflation. So imported inflation, if it's under control, then the others can also be taken care of gradually.
And as we head towards the end of the year, Professor Ghosh, what are your predictions for Q4 and the year ahead?
So as I have mentioned, that this is something that IMF report has mentioned recently as well, that in this whole thing called the Great Tightening, that means that a lot of concerted tightening of monetary policy has been maintained, but inflation has been a pretty difficult animal to deal with to some extent. So we see that it's gradually going towards that 2% long-term target, but obviously the conflicts that you alluded to before in the Middle East as well as Ukraine-Russia conflict might actually have a dampening impact on both the supply chain and disruptions that can happen, and the energy prices might shoot up as well. Right now they are low, so I think they are moving towards that longer-term 2% target. And obviously, most people, including the central bankers in this case, are keeping a close eye on this particular movement. U.S. Federal Reserve has already reduced the interest rate by 50 basis points in their October in the previous meeting, and they are expected to maybe cut more rates in future as well. But they are keeping an eye on the numbers gradually. So we expect that the numbers to come down, the inflation numbers to come down. And the other option is, of course, the growth to pick up to try to allay some of the fears of income not keeping pace with the prices.
All right, Dr. Aurobindo Ghosh there, Assistant Professor of Finance Education and Director of the Financial Literacy, Inclusion and Technology Program at SMU. Thank you.